How's it going, guys?
We're good. John, I put on
Going
makeup
great.
for the first time in like 3 weeks today too. So, we're all in that situation, like getting ready. And then for some reason, Ian's Zoom isn't letting anyone do video today. So
I know it's audio only. I'm sorry, guys. I wore a
okay.
button-down shirt for the first time in like 3 weeks. So, listen, I'll let Julie take it from here. Thanks so much again, and looking forward to hearing the chat.
Yeah, thanks, Ian.
Excellent. Thanks.
So, John, you and I first met a few weeks ago when I started diving more into PPP and how fintechs were trying to help small businesses and banks, speed up that process since the money was going so fast. And you guys obviously, are this system of APIs that can move data around very quickly and help out with that. And you focus on the policy front of it. So how about you take a step back? How did you get into policy? And, what have you been focused on over the last few weeks and kind of seen in terms of where things are evolving in such a, quick moving situation?
Uh, sure. I'll talk a little bit about my background, but move quickly past that since that's probably the least interesting part of the conversation, at least from my perspective. I was a lawyer early on in my career, and then when the CFPB was created, um, uh, had just saw it as an amazing opportunity to build a federal agency from scratch, and so moved into government at the CFPB and spent 6 years there trying to build the plane while flying it. And now that I'm at a real startup at Plaid, I will say that thinking you are in a startup when you are at a government agency is still light years away from the actual startup experience, but it got me really involved in policy, and particularly over the last 3 years of my time there, my role went from one that was trying to figure out how this new agency interacts with other federal agencies and states on policy to figuring out how all of these new apps and services that no one really knew how to categorize, starting with cryptocurrencies, but then rapidly moving into uh, data access and lending apps and payroll advance apps should intersect with the existing federal financial services law. And that sort of got me hooked on fintech. And when the opportunity came up to build a policy operation for Plaid, it was one I couldn't say no to, and came here uh, really because the core of all fintech, and really, I think what has become apparent over the last couple of months with both COVID and the PPP lending program, is the core of really all digital financial services, not just fintech, is the ability of the consumer to move their data from one place to another without any sort of friction or restrictions, so that they can get the services they want without having to go into a brick and mortar location and fill out a piece of paper. So that is a very brief sort of synopsis of how I got here. In terms of what I'm doing now, I mean, uh, it is crazy how much has changed over the last 3 months. And I know we all know that viscerally because our own individual lives have changed so much. Um, but it's hard to identify another period of time. I mean, even the 2008 financial crisis, frankly, pales in comparison in terms of the speed with which the federal government has made massive interventions, and also changed really long-standing policies in terms of how the federal government interacts with financial services. And so, frankly, have spent the last 3 weeks, 3 months drinking from a fire hose. It's not just PPP, it is everything. And also trying to see a little bit around the corner. And really, I think Melissa's conversation on the role of cash flow coming out of this crisis is fascinating. And I would love to talk more about that. But see around the corner too, as we move into recovery mode, what is the role that fintech and open finance and consumer-driven financial data sharing is going to have in the recovery, and what policies will we need to have in place to both support that and make sure that consumers are protected as more and more of their financial lives move into the digital realm.
Yeah, and I mean, before all of this happened, I remember sort of covering this space a bit and how banks and some others were a little bit skittish and sometimes against this, consumers controlling their data and stuff like that. Have you seen progress on that? Like, how has that dynamic kind of changed?
So it has changed, and I would say it has changed substantially. I guess at a high level, what I would say is banks have been thinking about their digital strategy for the last 5 years. This wasn't really a new thing where banks woke up mid-February and thought, oh my God, all of our branches are closed, all of our customers are online only, we have to build a digital strategy. It's been something banks have been working on, but the progress has been slow. And a number of banks took, as you said, over that period of time, sort of a perspective on, no, we don't want to just be sources of data. That feels risky to us. We don't necessarily like the direction the world is going. What's happened over the last 3 months is those digital strategies by the banks have accelerated and accelerated radically. I mean, almost 3 years worth of acceleration in some cases over that short period of time. And the PPP loans example is a good one if you sort of don't mind a quick digression. When the PPP program was launched and fintechs were given the opportunity by Congress and then by the SBA to participate as lenders in that program, we quickly spun up a product to help support those loans. One of the things that we were, frankly, a bit surprised by was we ended up getting as much interest from banks in using that product to support their own PPP lending as we did from fintechs. And the thing that's become clear, I think, to us in looking at the landscape is as banks have accelerated their digital finance strategy, they've also accelerated their realization that you can't have a digital finance strategy without having a data access strategy. And the quality of your digital offerings to your customers is really inextricably tied to the quality of the data that goes into your program and what the consumer is able to share with you. So, it's anecdotal on the PPP, but it really is evidence of this broader trend of rapid digital acceleration, banks starting to look more and more like fintechs in terms of what their digital strategies are. And part of that being an embracing, much more so than there had been previously, of data sharing as something that is as useful for banks and as beneficial for bank customers in their own offerings as it is for fintechs.
Right, right. And in regards to PPP, one of the questions that we have in our Q&A is, where has Plaid been able to add the most value so far, and have there been any unexpected quote unquote wins throughout the process?
Yeah, so I think the place where we've been able to add the most value is really just giving small businesses better access to their own data. For those who are not following PPP really closely, one of the most critical elements for a small business applying to a PPP loan, their average monthly payroll over the last year, because that determines their eligibility. So you can apply for 2.5 times your average monthly payroll over the last 12 months. That means the thing you need the most to accelerate that process of applying for a loan is a way to quickly share your 12-month payroll data with a potential lender in order to qualify you. It turns out, small businesses don't have the same data access right that consumers do. Coming out of the last crisis, Dodd-Frank 1033 gave every consumer the right to access their financial account information and share it with third parties. There still has not been a strong enough rulemaking around that, and I'm very hopeful that 1033 can continue to get fleshed out and expand that consumer data access right. But really, the thing that was clear in PPP is no similar right exists for small businesses. And so in some ways, we had to cobble together that tool for small businesses in a completely new market, and one in which I think a number of small businesses were surprised to find they don't have the same rights that consumers do. And so for us, the value add was being able to deliver that data access to small businesses and really start to put them on a level playing field with what consumers have been able to enjoy for the last 10 years. But the big surprise was this is an area where the market for small business fintech services still is lagging well behind the market for consumer fintech services and digital services. And I think the core of that is really driven by the lack of data access right. And it really speaks to the importance coming out of this crisis of expanding from sort of, for want of a better term, open banking in the United States to a real open finance system where both consumers and small businesses have the right to access their data, and the types of data that they have the right to access and share expands out beyond sort of narrow financial services into things like payroll and accounting and insurance, other areas where it's incredibly valuable financial information, and it really should belong to the data owner, and that data owner is the consumer or small business that generated the data.
Right, got it. So we asked earlier, the first panel, Samias from QED, if we thought, like what he thought COVID does to the pace of regulation changing, since he had brought up and others have brought up that it feels like the digitization of finance just like went on this massive squirt where you're getting like 5 to 10 years of changes happening in the matter of like 6 months to 1 year. What do you think regulation is going to be able to move fast enough? Like, what do you kind of see that dynamic doing?
I mean, not to be too much of a former government downer, but the reality is regulation sort of has one pace. There has been some really aggressive and good work done by SBA and the Federal Reserve and the CFPB and others to provide rapid guidance and really specific interpretations that help deal with this current crisis. But the reality is a regulation that requires, Administrative Procedures Act process and 90-day comment periods, there's no real way to accelerate that. And so there's probably still going to be a bit of a lag between where consumers and businesses are and the regulations catching up to them. I'm really hopeful that this is an opportunity to, for some of the offices of innovation that federal agencies have spun up, be it at the CFPB or the OCC or the FDIC, to look at more creative ways to provide interim guidance to help set the path for markets and consumers as things change. But the reality is that the comprehensive kind of regulations that you will need to capture some of these digital changes really are going to take a couple of years to do. And in some ways, I think that's a good thing, right? Because there's always a risk that a regulation is overly attuned to the current environment and really just covers a snapshot of what is happening now, and either cuts off innovation or cuts off promising developments that would have happened had the regulators taken a bit more time to let the market evolve. And so that's why I think this opportunity to pair both rapid guidance to handle market evolution and then slower, more deliberate regulation to accommodate some of the digital changes that are happening is probably ultimately fine, but we shouldn't be looking for sort of a big top-down revamp of the entire regulatory world for financial services anytime soon.
Yeah, no, I think that makes a lot of sense. In regards to PPP, that is an area where it feels like obviously there was a lot of government stuff changing quickly. And even just between the first round and the second round, there was a lot that happened. And we haven't really had too much time to catch up since the second round has been in place. So what encouraging things have you seen in the second round versus that first round that was gone in a matter of days?
Yeah, so I think one of them, to me, the single most encouraging thing is that the average size of the loan has gone down. And I know that's almost a counterintuitive thing to say, but let me explain my reasoning there. The smallest businesses, the mom and pop operations with just a few employees, are the ones with the least cash on hand, and also the ones that really felt the sharpest impact from the COVID-related shutdowns. They also happen to be the types of businesses that fintech lenders really specialized in lending to over the last 5 to 10 years. It's an area where there still is a lot of great community bank lending, but for many of the larger banks, that's just not a market that they have lent to over the last 10 years, and that market need has been filled by fintechs. Those small businesses, sort of the ones who are on the first rung of the small business ladder, need smaller loans than the larger businesses. And so to me, this second round was the first round in which fintechs were able to fully participate. Those fintechs lend to the smallest small businesses. And so if you take that loan size as a proxy for, is the money getting to those really small businesses who desperately need it? And are fintechs being able to really fill their market niche as part of a government program and make effective loans to those very small businesses? I think that the drop in average loan size is a great leading indicator for that. The other thing that I will say that is I view as incredibly promising is actually something the Fed did, which was open up the secondary market facility that they established to repurchase these PPP loans to fintechs. If you just think about this structurally, the fact that the Federal Reserve is now opening a facility to fintechs is frankly a sea change in terms of the recognition of the role that fintech plays in the US credit markets, particularly for small businesses, and is one that I think is a quite promising signal in terms of what the government's view of the role of fintechs in the future of the US credit markets is going to be. It's probably not as important as the fact that the AP style book has now officially recognized fintech as something that reporters can use in their writing, but it is second only to that in the importance of the overall economy right now.
Right. So, I mean, I know it's hard to kind of look past what we're currently going through, but where do you, I mean, once the PPP is kind of behind us, COVID's behind us, where do you see your attention being directed, for future regulations, whether that be later this year or next year?
So two things. One, I really think coming out of this crisis, there needs to be a broad-based movement to push us into open finance, in particular, making sure that small businesses have access to their data. I covered that before, so I won't belabor the point, but I think there are a number of small businesses who were surprised to find that they didn't have that right and are not going to tolerate not having access to their own information going forward. And I think there's an opportunity to have the same flourishing of fintech and other personalized services for small business coming out of this crisis that consumers enjoyed coming out of the 2008 crisis. The other thing that I am very, very focused on, and Melissa talked about it, though she was unduly humble in talking about how influential her role has been in really getting this conversation to move forward, is cash flow underwriting. Depending on how long this crisis lasts, the average credit file for most consumers is going to be less predictive coming out of this crisis than I think any time in recent memory. And the reason for that is, one, there are so many government programs allowing you to defer payments on mortgage, defer payments on student loans, that are going to be populating the trade lines on those credit reports that I don't think anyone will know really what it means if a consumer has taken that option or not. Frankly, there's already been reporting about, in the student lending space, student lenders misreporting and putting bad reports on credit files for people who were exercising their right under a program and shouldn't have been dinged on their credit report. We've also had 40 million people file for unemployment during this crisis. And so if this goes on for a prolonged period of time, you're going to have credit reports from most Americans where, the most recent 6, 9, maybe even 12 months of data are really, really messy. But those people coming out of the crisis and those small businesses coming out of the crisis are desperately going to need access to credit. And I think cash flow underwriting is going to be the only real-time and predictive way for many of them to get that access to credit. So unless we are willing to settle for a post-crisis recovery where millions of people are left out of credit and blocked from credit that they can responsibly take in order to rebuild their finances and rebuild their lives, we're going to have to lean much more heavily than before on cash flow underwriting. And Melissa's done an amazing job in accelerating that conversation, almost a prescient job in getting us to the place where, these federal agencies have been able to provide guidance on cash flow underwriting as being something that banks can employ to make responsible small dollar loans to consumers and small businesses. I'm frankly very excited by the possibility of banks that are launching their own digital strategies and relying on cash flow data to use companies like Plaid or our competitors or others to help generate that information and really add more value to their customers by making those small dollar loans as part of the recovery. But I think it's all going to hinge on cash flow and the ability both of banks and fintechs to get access to that good data and use it in their underwriting models, and of the regulators to view this as a viable and critical part of underwriting moving forward, because the credit reports are going to be so weak in terms of their predictiveness because of what happened to so many people during the crisis.
Yeah, I have time for one, maybe two more questions. So I think the most important one I want to get to is, like, where does the innovation need to come from then? Like, if you're someone that's starting out a new startup or someone that is early on working in government, like how are we going to keep moving forward and innovating in finance? Is it going to come from, Plaid obviously has done a lot to make it so data is more open and whatnot. So having the startup there to kind of like push in that change, forces government regulators to act and whatnot. How do you see that evolving?
So this is one where I'm actually really optimistic. Dodd-Frank 1033 in relevant part is 75 words long and 10 years old. Compare that, and on the back of those 75 words, in the last 10 years, we have gone from effectively no such thing as a fintech in the US to Plaid having by itself more than 2,600 fintech customers. If you contrast that to Europe, where they did a very heavy top-down open banking regulation, the entire European market has 200 registered fintechs in it, and 160 of those are in the UK. So I'm really confident that we have a great market driver for that innovation right now, and are able to drive an immense amount of innovation on fairly limited permission from the government. Again, 75 words in Dodd-Frank 1033 sprung forth thousands of fintech companies that were willing to innovate and drive new consumer product. I think we are now at the stage where a little bit more lightweight government nudge in the direction of how they want the market to evolve will be immensely helpful. I actually think the OCC fintech FAQs that talked about how banks should interact with fintechs could be potentially helpful there. And so I think that combination of the market dynamism of the US being able to build on relatively broad permissions without having to have prescriptive regulation, combined with a real effort by the federal regulators and their offices of innovation to make a few tweaks, give a few nudges, and then really lean lightly, but for real, on the incumbent players to embrace some of these more innovative services are the key ingredients to making sure this continues to be a vibrant part of the economy and really help consumers and small businesses come out of this crisis.
Yeah, it does seem like each side, from the startup world to the government world, everyone, wants the best thing to happen and innovation to take place. It's just a little messy sometimes, and there's some, little roadblocks that we have to get through and everything too. But it does seem that the mindset and the goals and the drive to have that happen is there on both sides of the aisle, and I find that very encouraging. And it's one of the reasons that I hope that we continue to talk quite a bit. John, this was great. And I hope that the participants also enjoyed this. This is the conclusion of all three of our panels. So everyone can either go get lunch or go get coffee if you're on the West Coast, go get dinner if you're over in the UK. And yeah, thank you again.
Thanks a lot, Julie. It was great talking with you.
Likewise.